In modern America, crises rarely begin with panic. They begin quietly, inside balance sheets, bond markets, and government borrowing schedules few citizens ever see. The United States today carries more than $38 trillion in federal debt, a figure growing faster than national income itself. Every few months, another trillion is added, almost unnoticed by daily life. Yet beneath stable employment numbers and resilient stock markets, a deeper shift is unfolding. Interest payments alone have crossed $1 trillion annually, transforming debt from a policy tool into a structural dependency. For decades, low interest rates masked this reality. Borrowing felt inexpensive, even rational. But as rates climbed toward roughly 3.75%, the cost of sustaining past decisions began compounding rapidly. Investors quietly started pricing new risks through sovereign CDS markets, instruments once associated with emerging economies, not the world's reserve currency issuer. This documentary begins at that uncomfortable moment in history, when prosperity continues on the surface, yet the financial architecture supporting it grows increasingly fragile. The question is no longer whether America has debt, but whether debt has begun to reshape America itself. The first visible signs of a debt cycle rarely appear in government announcements. They emerge through subtle distortions across financial markets. In the United States, long-term Treasury yields began rising faster than short-term growth expectations, creating repeated yield curve inversions. Historically one of the most reliable recession indicators. At the same time, mortgage rates surged beyond levels unseen in 2 decades, freezing housing transactions across major metropolitan areas. Home affordability collapsed even as property prices remained elevated, trapping both buyers and sellers in economic paralysis. Liquidity conditions also tightened. Regional banks faced deposit outflows as higher interest rates pulled capital toward money market funds offering safer returns. Credit spreads widened quietly, signaling investor concern about corporate refinancing risks. Meanwhile, the US dollar strengthened against emerging currencies, exporting financial stress abroad, a pattern seen before global downturns. None of these signals alone confirmed crisis. But together, they revealed something more dangerous, an economy increasingly sensitive to the very interest rates required to control inflation. If prosperity once depended on growth, stability now depended on continuous borrowing. Economic shocks within a debt-driven system do not spread randomly, they follow predictable financial mechanisms. When interest rates rise, governments, corporations, and households simultaneously face higher refinancing costs. In the United States, trillions of dollars in Treasury securities must be rolled over each year. Even small increases in yields translate into massive fiscal pressure. Corporations that relied on cheap debt during the era of near-zero rates suddenly confront shrinking margins as borrowing costs reset. This mechanism creates what economists call a liquidity squeeze. Banks tighten lending standards, venture capital slows, and speculative investment retreats. Asset prices, particularly technology equities and commercial real estate, begin adjusting downward. Falling collateral values then reduce borrowing capacity, reinforcing contraction. Credit default swap spreads, once stable, start widening as markets reassess default probabilities across sectors. Unlike traditional recessions caused by declining demand, debt cycle crises originate from balance sheet stress. The system does not fail because people stop spending, it weakens because financial obligations accumulated during prosperity become unsustainable under new monetary conditions. The shock, therefore, is mathematical before it becomes emotional. History shows that debt crises often begin far from where their consequences are ultimately felt. In 1997, several Asian economies experienced rapid capital flight after currency pegs collapsed under dollar pressure. Nations that had borrowed heavily in foreign currencies suddenly faced exploding repayment costs as exchange rates depreciated. The IMF intervention stabilized markets, but only after deep recessions reshaped entire societies. What appeared at first as a regional disturbance revealed a universal vulnerability: dependence on external liquidity. A similar pattern unfolded in Argentina, where repeated borrowing cycles ended in sovereign default when investor confidence evaporated. In Greece, rising bond yields transformed public debt into a national emergency almost overnight, forcing austerity measures that reduced wages, pensions, and employment opportunities for an entire generation. These cases differed politically and culturally, yet shared one structural truth: once debt servicing consumes economic growth itself, policy choices narrow dramatically. The lesson for larger economies was clear: scale delays crisis, but it does not eliminate underlying financial arithmetic. The United States differs from past crisis economies in one critical advantage: it issues the world's primary reserve currency. Global trade, commodity pricing, and sovereign reserves remain heavily denominated in US dollars. This privilege allows America to finance deficits at conditions unavailable to countries like Greece or Argentina. Yet reserve status also creates a paradox. As global uncertainty rises, capital flows into U.S. treasuries, strengthening the dollar and tightening financial conditions worldwide. A stronger dollar increases pressure on emerging markets holding dollar-denominated debt, as seen repeatedly in Turkey and Venezuela, where currency depreciation accelerated inflation and capital instability. But the feedback loop eventually returns to the United States itself. Global slowdowns reduce export demand, multinational earnings weaken, and financial volatility spreads back through equity and credit markets. In this interconnected system, America becomes both safe haven and transmission channel. Stability attracts capital, but sustained inflows inflate asset valuations and expand leverage, reinforcing the very debt cycle that now defines modern economic resilience. As debt expands, its impact moves beyond financial charts and into the structure of everyday American life. Federal interest payments now compete directly with public spending priorities such as infrastructure, healthcare, and education. Each rise in Treasury yields forces policymakers to allocate a larger share of tax revenue simply to service past borrowing. Unlike discretionary programs, debt obligations cannot be postponed. They compound automatically. For households, the consequences appear through higher borrowing costs. Credit card interest rates climbed above historical norms, auto loans became more restrictive, and small business financing tightened significantly. Commercial real estate vacancies increased as refinancing costs surged, placing regional banks under renewed stress. Office buildings once valued as stable income assets suddenly faced declining occupancy and falling collateral prices. This transition marks a subtle but powerful shift. Economic growth no longer primarily improves living standards; instead, an increasing portion of national productivity sustains financial commitments accumulated over decades. The debt era transforms prosperity into maintenance, preserving stability rather than creating expansion. Faced with rising instability, the response of governments and central banks follows a familiar sequence. The Federal Reserve first attempts to restore balance through monetary tightening, raising interest rates to contain inflation and stabilize currency credibility. Higher rates strengthen confidence in the dollar but simultaneously increase stress across leveraged sectors. Policymakers therefore walk a narrow path between inflation control and financial disruption. When liquidity pressures intensify, intervention mechanisms quietly emerge. The Federal Reserve expands repo facilities, provides emergency lending windows, and stabilizes banking institutions facing sudden funding shortages. During recent market stress episodes, swap lines with foreign central banks ensured global access to dollar liquidity, preventing international funding markets from freezing. These actions rarely appear dramatic, yet they function as modern financial firefighting tools. However, each intervention introduces moral hazard. Markets begin assuming future support, encouraging continued risk-taking. The system survives immediate shocks, but dependence on central bank liquidity deepens. Stability becomes managed rather than organic, sustained through policy rather than self-correcting economic forces. Yet monetary intervention alone cannot resolve structural debt expansion. Fiscal policy increasingly becomes the second line of defense. Successive U.S. administrations, regardless of political orientation, have relied on deficit spending to sustain economic momentum during periods of slowdown. Stimulus programs stabilize employment and consumption, but they also accelerate borrowing requirements. Government debt issuance rises precisely when markets are already absorbing large volumes of Treasury securities. This dynamic alters investor behavior. Foreign central banks, once dominant buyers of U.S. debt, gradually diversify reserves into gold and alternative currencies to reduce exposure. Domestic institutions, pension funds, insurance companies, and banks absorb a larger share of issuance, tying national financial stability more closely to sovereign debt performance. Liquidity remains available, but flexibility narrows. The challenge becomes cyclical. Economic weakness demands stimulus, stimulus increases debt supply, and higher debt eventually pressures interest rates upward. Policymakers are no longer choosing between growth and austerity, they are managing time, attempting to delay adjustment while maintaining confidence in long-term solvency. The consequences of prolonged debt cycles are often most visible in asset markets, where liquidity first accumulates and later retreats. Over the past decade, low interest rates encouraged unprecedented expansion in equity valuations and real estate prices across the United States. Technology companies financed growth through cheap capital, while investors increasingly relied on leverage to enhance returns. Rising asset prices created a powerful wealth effect, reinforcing consumption even as wage growth lagged behind inflation. But when interest rates rise, valuation models change rapidly. Future earnings are discounted more aggressively, reducing stock market multiples. Commercial real estate faces particular vulnerability, as properties financed under near-zero borrowing costs must refinance at significantly higher rates. Falling property values weaken bank balance sheets and reduce lending capacity. Liquidity begins to concentrate among larger institutions while smaller borrowers lose access to credit. This adjustment phase rarely appears dramatic at first. Markets fluctuate rather than collapse. Yet beneath volatility lies a gradual repricing of risk, the moment when debt-fueled optimism confronts financial reality. Global comparisons reveal how debt stress evolves once confidence begins to erode. In Greece, government borrowing remained sustainable for years until bond markets abruptly demanded higher yields. Within months, refinancing costs surged beyond fiscal capacity, forcing emergency assistance and strict austerity measures. Economic contraction followed, unemployment exceeded 25%, and household wealth declined sharply. The crisis did not emerge from sudden overspending alone, but from markets reassessing long-term repayment credibility. In Turkey, persistent currency depreciation amplified external debt burdens denominated in foreign currencies. Inflation accelerated as the lira weakened, reducing purchasing power and destabilizing domestic investment. Meanwhile, Venezuela demonstrated the extreme outcome of fiscal imbalance combined with monetary collapse, where excessive money creation destroyed currency confidence entirely. These cases differ from the United States in institutional strength, yet they illustrate a shared principle: debt crises unfold when financing conditions change faster than economic adaptation. Confidence, once lost, moves quicker than policy response, transforming financial stress into social reality. In the United States, the impact of debt dynamics increasingly shapes labor markets and income distribution. While unemployment rates may remain relatively low, job quality and wage stability reveal deeper pressures. Companies facing higher financing costs often delay expansion, reduce hiring momentum, or shift toward automation to preserve margins. Productivity gains continue, yet their benefits concentrate among capital owners rather than wage earners. Households experience this transition indirectly. Rising living costs, particularly housing, healthcare, and education, outpace median income growth. Adjustable-rate mortgages reset at higher payments, while consumer debt balances expand to maintain consumption standards. Credit card delinquencies begin rising gradually, not as sudden collapse, but as evidence of financial strain spreading through middle-income households. This divergence creates what economists describe as a two-speed economy. Asset holders benefit from accumulated wealth, while debt-dependent households face increasing vulnerability to interest rate shocks. Economic stability persists statistically, yet financial resilience becomes unevenly distributed across society. Financial markets often register stress long before it appears in employment or consumption data. One of the most closely watched indicators during debt cycles is the credit default swap, or CDS market, which reflects investor perception of default risk. While U.S. sovereign CDS levels remain relatively low compared to emerging economies, even modest increases signal changing expectations about fiscal sustainability. Markets rarely panic without warning, they adjust gradually through pricing mechanisms invisible to most citizens. Liquidity indicators tell a similar story. Bank reserve balances fluctuate as quantitative tightening removes excess money from the system. Treasury market volatility increases when supply outpaces natural demand, forcing higher yields to attract buyers. These movements ripple through mortgage rates, corporate bonds, and municipal financing costs. Such shifts do not imply imminent collapse. Instead, they represent tightening financial conditions across interconnected sectors. The economy continues functioning, but with less margin for error. In debt-driven systems, resilience depends not on growth alone, but on continuous access to affordable liquidity. As financial pressure builds, the interaction between exchange rates and global capital flows becomes increasingly important. The US dollar strengthens during periods of uncertainty because investors seek liquidity and perceived safety. While this reinforces America's financial dominance, it also produces unintended consequences. A stronger dollar reduces competitiveness for U.S. exports and tightens global financial conditions simultaneously. Emerging economies holding dollar-denominated debt must allocate more local currency to meet repayment obligations. This dynamic contributed to crises in countries like Argentina and periodic instability in Turkey, where currency depreciation accelerated capital flight. Global demand slows as foreign economies contract under dollar pressure, eventually feeding back into American corporate earnings and investment activity. The United States therefore occupies a unique position within the debt era. Its currency provides global stability, yet maintaining that stability requires higher interest rates that increase domestic borrowing costs. The same force protecting financial credibility gradually intensifies internal economic strain. Debt cycles ultimately influence one of the most sensitive pillars of economic stability, the housing market. In the United States, real estate functions not only as shelter but as the primary store of household wealth. During years of low interest rates, mortgage borrowing expanded rapidly, pushing home prices far beyond historical income ratios. Rising valuations created confidence, encouraging refinancing, consumption, and construction activity. When interest rates increased, affordability declined sharply. Monthly mortgage payments for new buyers rose dramatically even without further price increases. Housing supply tightened as existing homeowners, locked into low fixed-rate loans, avoided selling. Transaction volume slowed, reducing liquidity across the market. Developers postponed projects while regional banks faced growing exposure to commercial and residential property loans. Unlike previous housing crashes, the adjustment unfolds slowly. Prices may not collapse immediately, but stagnation itself becomes economically restrictive. Housing mobility declines, labor flexibility weakens, and consumer spending slows, demonstrating how debt conditions reshape economic behavior without visible crisis headlines. Behind these market adjustments lies a deeper transformation in government finance. As borrowing expands, fiscal flexibility gradually narrows. A growing share of federal revenue is directed toward interest payments rather than productive investment. Infrastructure modernization, social programs, and industrial policy increasingly compete with debt servicing obligations accumulated over decades. The challenge becomes intergenerational. Future taxpayers finance past stability. This pattern has appeared before in heavily indebted economies. In Greece, fiscal tightening reduced public services to restore market confidence. In Argentina, repeated restructuring cycles undermined long-term investor trust. The United States retains far greater institutional credibility, yet the underlying arithmetic remains similar. Sustained deficits eventually limit policy options during future downturns. When economic shocks arrive, governments traditionally respond with spending expansion. But in a high-debt environment, stimulus risks triggering higher borrowing costs instead of recovery momentum. Policymakers must therefore balance short-term stabilization against long-term sustainability, a dilemma defining the modern debt era. Central banks confronting debt-heavy economies face an increasingly complex dilemma. Raising interest rates helps control inflation and defend currency credibility, yet prolonged tightening risks destabilizing financial institutions dependent on cheap funding. Lowering rates, on the other hand, may reignite inflation and weaken confidence in monetary discipline. The Federal Reserve operates within this narrow corridor, adjusting policy while monitoring liquidity across banking and capital markets. Recent episodes of regional bank stress demonstrated how quickly confidence can shift. Unrealized losses on long-duration government bonds expanded as yields rose, weakening bank balance sheets despite technically safe assets. Emergency lending facilities were introduced to prevent forced asset sales, reinforcing stability without reversing monetary policy entirely. Such interventions highlight a defining feature of the debt era: financial systems become highly sensitive to interest rate movements. Stability depends not only on economic growth but on carefully calibrated policy timing. Monetary decisions now carry systemic consequences extending far beyond traditional inflation management. For individuals, the debt era is not an abstract macroeconomic concept but a daily financial reality. Rising interest rates influence mortgage payments, rental costs, student loans, and credit card balances simultaneously. Households that once relied on refinancing or low-cost borrowing to manage expenses now face reduced financial flexibility. Even stable employment no longer guarantees economic security when debt servicing absorbs a growing share of income. Personal financial resilience increasingly depends on liquidity rather than income alone. Savings buffers, diversified investments, and manageable leverage become essential defenses against economic volatility. During past crises in Argentina and Turkey, families that preserved access to cash or hard assets adapted more successfully than those fully exposed to currency or credit risk. The lesson extends beyond emerging markets. In highly leveraged economies, individuals mirror national balance sheets. Stability arises from reducing dependency on continuous borrowing and maintaining flexibility when financial conditions shift unexpectedly. Personal strategy becomes a form of economic survival. One practical response for households navigating a debt-driven economy is understanding the role of interest rate cycles. Periods of tightening typically reward savers while penalizing excessive leverage. Fixed-rate obligations become valuable protections, insulating borrowers from sudden payment increases. Conversely, variable-rate debt exposes households to policy decisions made far beyond personal control. Financial planning increasingly revolves around managing exposure to rate volatility rather than maximizing short-term returns. Diversification also gains renewed importance. During episodes of currency instability in countries like Venezuela, concentrated wealth stored in a single asset or currency proved highly vulnerable. While the United States maintains stronger institutions, global interconnectedness means shocks can travel quickly across markets. Balanced allocation between cash reserves, productive assets, and long-term investments helps reduce systemic exposure. In uncertain environments, resilience often appears conservative. Preserving liquidity, limiting speculative debt, and maintaining adaptable financial structures allow individuals to withstand economic transitions without being forced into unfavorable decisions during market stress. Businesses face similar challenges as the debt era reshapes investment decisions across the American economy. During years of cheap capital, expansion strategies prioritized growth over efficiency. Companies borrowed aggressively to finance acquisitions, stock buybacks, and technological scaling. As borrowing costs rise, these strategies become increasingly difficult to sustain. Profitability regains importance, and access to refinancing determines survival for highly leveraged firms. Small and medium-sized enterprises are particularly vulnerable. Unlike large corporations with bond market access, smaller firms depend on bank lending sensitive to liquidity conditions. Tightening credit standards slow hiring, delay innovation, and reduce local economic dynamism. This gradual contraction rarely produces headlines but accumulates across thousands of communities. Historical parallels can be seen in post-crisis Greece, where restricted credit weakened entrepreneurship for years after financial stabilization. The American economy, though larger and more diversified, faces a comparable adjustment, shifting from debt-fueled expansion toward capital discipline and operational sustainability. Geopolitical risk further complicates the debt cycle, linking economic stability with global power dynamics. Trade fragmentation, sanctions regimes, and strategic competition increasingly influence capital flows and currency reserves. Nations have begun exploring alternatives to dollar settlement systems, not necessarily to replace the dollar immediately, but to reduce dependence during periods of political tension. Even marginal diversification alters long-term demand for U.S. Treasury securities. Energy markets illustrate this connection clearly. Commodity pricing volatility affects inflation expectations, forcing central banks to maintain restrictive policies longer than anticipated. Higher interest rates sustain currency strength but also elevate sovereign borrowing costs worldwide. In past crises, including emerging market debt shocks supported by IMF programs, geopolitical instability accelerated financial contagion by undermining investor confidence. For the United States, economic leadership now depends as much on maintaining financial credibility as military or technological dominance. Debt sustainability becomes intertwined with global trust, a strategic asset as critical as economic output itself. As debt accumulates across advanced economies, financial markets begin adjusting expectations about long-term growth itself. Investors increasingly question whether future expansion can outpace the obligations already embedded within public and private balance sheets. Productivity growth becomes essential, yet demographic aging and slowing workforce expansion limit traditional drivers of economic momentum. The United States faces a future where innovation must compensate for structural financial weight. Japan offers a partial comparison. Decades of high public debt did not trigger sudden collapse, but resulted in prolonged low growth and persistent monetary intervention. Stability was preserved, yet dynamism weakened. This outcome suggests that debt crises do not always arrive as dramatic breakdowns, sometimes they manifest as gradual stagnation. For America, the risk may not be immediate insolvency but reduced economic flexibility. When growth slows while obligations remain fixed, policymakers operate within increasingly narrow margins, turning long-term prosperity into a continuous effort to sustain equilibrium. The psychological dimension of economic cycles often receives less attention than financial indicators, yet confidence remains one of the most powerful forces in modern economies. Consumer expectations influence spending decisions, investment timing, and housing demand long before measurable downturns occur. When households begin anticipating instability, precautionary savings increase while discretionary consumption declines. This behavioral shift alone can slow economic activity. During the Greek debt crisis, declining confidence accelerated capital withdrawals even before formal austerity measures began. In Argentina, recurring inflation expectations led citizens to convert savings into foreign currency at the first sign of instability. The United States benefits from stronger institutional trust, yet surveys increasingly show rising concern about long-term inflation, retirement security, and purchasing power. Economic systems function smoothly when participants believe future stability is likely. Once uncertainty becomes embedded in expectations, financial tightening can occur organically, independent of government policy or central bank decisions. Confidence, once weakened, is difficult to restore quickly. In response to prolonged uncertainty, long-term personal strategy increasingly shifts from maximizing growth toward preserving adaptability. Financial resilience in the debt era depends on maintaining optionality, the ability to respond when economic conditions change unexpectedly. Households with diversified income sources, manageable debt levels, and emergency liquidity buffers demonstrate greater stability during tightening cycles. Historical experience reinforces this lesson. During currency crises in Turkey and inflationary periods in Venezuela, individuals who relied solely on fixed income streams faced rapid declines in purchasing power. Those able to adjust spending, relocate employment, or access alternative assets adapted more effectively. While the United States operates within a more stable monetary framework, globalization ensures that volatility can still transmit through markets and employment sectors. Practical preparation therefore emphasizes flexibility, avoiding excessive leverage, investing in transferable skills, and maintaining financial reserves capable of absorbing temporary disruption without forcing irreversible decisions. Ultimately, the debt era forces societies to reconsider the meaning of economic stability itself. For much of the post-war period, growth expanded faster than obligations, allowing rising living standards alongside manageable borrowing. Today, stability increasingly depends on maintaining confidence within a system already operating at high leverage. Expansion becomes secondary to preservation, preventing disruption rather than pursuing acceleration. The United States remains uniquely positioned, supported by innovation capacity, deep capital markets, and global trust in the dollar. Yet history suggests that financial dominance does not eliminate cycles, it merely changes how they unfold. The experiences of the IMF interventions in 1997, the sovereign struggles of Greece, and repeated defaults in Argentina all demonstrate that adjustment eventually follows imbalance. The most dangerous economic cycles are rarely defined by sudden collapse, but by gradual normalization of risk. The debt era asks a profound question, not whether crisis is inevitable, but whether societies can adapt before mathematics forces change.